Imagine this, by 2035, you could be sitting on a multi-million dollar property portfolio that generates wealth and passive income while you sleep. Sounds bold, but it's exactly what I've done. My property portfolio sits at $5 million, and in the last 12 months, it has gone up by $1 million in equity. My name is Nick. I am the director at Handle Properties, a buyer's agency and property advisory firm based out of Sydney. We help clients buy investment properties all over the country. And today, I'll walk you through a realistic and step-by-step property investment plan to help set you up for serious wealth by 2035. Firstly, I'll tell you why I think you should be using property as a vehicle for long-term wealth creation. This comes from my experience as a financial planner. It's simple. It's a tangible asset class that holds value and grows over the longer term. You can see it, you can touch it, you can also add value to it. You can go in and do a renovation, you can go in and do a subdivision or a knockdown and a rebuild. Property offers both the benefits of capital growth and passive income. It is a great way to build wealth for the long term. But here's the kicker. If you went to any mainstream financial planner, and I can say this because I was a financial planner before, they will push you down the route of stocks, ETFs, they'll do a bit of superannuation and insurance. But if you ask them, how can I build long-term wealth creation? Not a single one of them will talk to you about property and helping you execute and buy the right property portfolio over the longer term. That's mainly because the legislation does not allow financial planners to talk about property. Don't let typical financial planning advice steer you away from using real estate to build long-term wealth. To build wealth through property, let's break down the three essential phases. The first one is the growth phase. If you're starting at zero, you need to start acquiring properties with strong growth potential. Cash flow may be tight, but here you're building the foundations for a long-term successful property investment strategy. Once you've built that good foundation, and you're accumulating your first, second, third, fourth properties, you then start thinking about how you can consolidate your portfolio. You might be acquiring these properties in your growth phase over 3, 4, 5, 7 years. This is where you start thinking about consolidating the portfolio, where you start to sell some assets to pay down your debt so that it is a lot easier to manage and hold that portfolio for the longer term. Once you're good at that consolidation phase, this might be 10 to 15 years down the line, is when you start restructuring your portfolio for that income phase. This is when financial freedom starts to become a tangible reality. Now you're holding your very best assets that have strong cash flow and have very little debt. When it comes to your income phase is when you start selling down more high quality assets to completely exterminate your debt or bring your debt levels down to manageable levels where what you have left with is sustainable income that you can use to support your lifestyle and any other ventures that you may have. This is where the magic happens. It takes time, it takes a lot of patience, but it is a reality that you can achieve through property. That's the strategy of growth, consolidation, and income. But now you want to start actually going and finding properties. Now you can't just go on real estate or domain and just pick up anything within your budget and hope that it makes money, because not all properties are created equal. That's what I really love about the property market. Every property has its nuanced benefits, risks, and opportunities, because every property sits on its own block, which has its own characteristics, on its own street, in its own suburb. It's not a vanilla one-to-one asset. When you are looking for property, keep in mind that not all properties are equal. You have to look for scarcity. You have to look in areas where there's lots of demand from not only people who want to live in the property, so owner-occupiers, but also renters, because you want a bit of both, because owner-occupiers drive prices up, good tenants drive incomes up. Because high demand and limited supply areas appreciate faster. And remember to stay away of flashy property spruikers selling those cookie cutter and off the plan apartments. If you go to people that call themselves buyer's agents and they start flogging you house and land packages, existing properties, or off the plan apartments, stay clear and run away. They work for developers. They are not your advisors. They get paid by the developer to put a property in front of you at a detriment to your financial future. In your journey, it's also incredibly important to understand your risk profile. Your risk profile in property will help direct you towards the types of locations, the types of properties that you would be comfortable buying in, and also the amount of leverage that you're open to buying in. If you want something safe and long-term, you might feel more comfort buying in a capital city and keeping within your budget, even if the yields are a little bit less. But if you have a more aggressive risk profile, you can start to consider, how can I buy properties that might be in regional areas, that might be in fringe areas where the data supports long-term growth, but they're not your traditional investments that you hear about. The next important aspect of your journey is your financing strategy. Don't go to any mortgage broker. Most mortgage brokers do not understand long-term financial planning and do not understand your longer-term goals. They will basically just say, give us your pay slips and this is the amount of money you can borrow and on your way. But that's not the right way to go about it. And what we do differently is to really understand, where does this investment property transaction fit in your broader goals and your broader strategy? Because the worst thing that you can do is get a loan pre-approved by a basic mortgage broker, spend the money, buy a property, but there has been no thought or care taken into account in terms of how quickly you want to buy your second property or your third property, or how big your portfolio needs to be. So we very much recommend that you find a mortgage broker and let them model with you how your income sits today, how your family income sits today, how that family income is going to grow over the next 10 years, and basically work backwards to backfill what property assets does my income allow today and how much will it allow in the future. Again, model in, how would those properties grow in value? How would those properties' incomes grow in value? And basically, you want to model the amount of properties you need in your situation to meet your broader financial objectives. There's also other really creative ways to boost cash flow in your property. And this is where it comes back down to your risk tolerance and your ability to find deals. So if you want to boost your cash flow, you can consider things such as buying property with sufficient land where you can add a granny flat. Granny flats are great because they cost about $150 to $200 and they can boost your income by $400 to $500 and also increase the value of that property, usually for more than the cost of the granny flat itself. But you might also want to start thinking about, how can I boost the rental income of this property through other ways? Again, comes back down to your risk tolerance and your ability to think smart in this space. You might consider putting up the property for Airbnbs. You might consider renting out each room individually with the right property manager and the right legislation. So get creative about maximizing your returns. And the one thing in all of this that is super important is think beyond just this property. You need to be thinking 3 to 5 moves ahead. And this is when you might want to start thinking about the trusts and the structures that sit behind the ownership of your property portfolio. These are the entities that ultimately hold the assets, and there are great benefits for each one of these. But this is what we do in and out. Coming from that financial planning background, we bring that sophisticated wealth management practice into not only what properties to buy, but in which entity they need to sit in and how those entities interrelate with each other so that the mortgages can be maximized and your financing situation can be maximized. We're the buyers, agents, and strategists, but we will work with accountants and our mortgage brokers to really build you a solid and structured team around your investment journey. Because with the right people, you're going to be set up for success and you're going to avoid costly mistakes along the way. What's your biggest investment property challenge? Drop a comment below because I'd love to hear about it. And if you found this video useful, please give it a like and a subscribe for more property investment insights. At Handle Properties, we're here to make your investment journey smoother and smarter and more profitable. So if you're ready to take that first step or that second step because you're looking to buy that second or third property and start building wealth the right way for the long term, reach out to us today. We guarantee that you'll leave one of our sessions with a fresh perspective on your property investment journey.